Truth is, I thought it mattered. I thought that
money
mattered. But does it bollocks? Not compared to how people matter.
Welcome, mention, and other fine folks to the Sunday Dispatch of the Black Letter, where we contemplate thoughts worth thinking in this upside down, the topsy-turvy we find ourselves in. Today we've got a bunch of things on the go. We're going to talk about precious metals, the economy, of course, the Fed, a big part of that economic bubble we find ourselves in, and we'll take a look at some of the markets, see where we're at heading into the weekend here. So from Market Watch, silver, copper prices mark an impressive recovery from March lows. At their lowest level in March, silver futures were down as much as 34% year to date. Silver has erased its loss for the year, and copper is looking to recoup the bulk of the declines. The drop in global mining production from the shutdowns helped buoy prices of both commodities. Declines in mining production helped buoy the prices for the metals as 2/3 of global silver output and an estimated 13% of copper production went offline, obviously related to the pandemic we're in. In Chile and Peru, which account for nearly 40% of global copper output, coronavirus cases have accelerated and might lead to a second wave of mining shutdowns. And of course, that will just contribute to even higher prices, in my opinion. A second wave of virus infection probably would put even more fuel under silver's price rally. And then the one analyst expects silver to test $21 before the year end. Copper's outlook, however, isn't as upbeat. The market for the metal could see a 2020 surplus around 200,000 metric tons. As you guys know, I'm a big fan of precious metals at the moment. I think it's one of the few asset classes right now that offer greater potential. That is to say, I think that they're undervalued, silver particularly. Gold is approaching all-time highs, as silver isn't, as we'll see in a while when we take a look at silver future charts. So if you were to get into the stock market, or if I was to get into the stock market, I might look at something like a silver ETF for potential in the coming year or two. However, who knows if silver will hit the prices that it should in a year or two, but I think it will. I think there's a good chance. Copper as well. I think all other commodities generally are probably undervalued to some degree, although I'm just focusing on silver. A quarter of all personal income in the US now comes from the government. Now, what is this? Socialism? Communism? I'm not sure where we're heading. I have nothing against socialism, that's for sure, especially democratic socialism, whereby we have a free market, but at the same time a government that helps those with a safety net from falling into desperation and deep poverty. But of course, in America, socialism is practically equated with communism, and I see the two as being slightly different. Following today's release of the latest personal income and spending data, which showed a record jump in personal spending to be expected 1 month after the savings rate in the US hit a whopping 32% annualized, a record drop in personal income as government benefits and stimulus checks slowed down substantially. So up at the top here we can see US personal income, and it spiked hugely, 11% that was in April, right? I think when all the stimulus checks came out. You can see it's dropped in the months before and the month after. And of course now we're seeing that spending is starting to hit the streets, I think. It's a huge spike, as you can see. Something to watch for, because of course, as we've mentioned before, if spending starts to escalate, that means the velocity of money is starting to escalate and money starting to circulate in the economy, which will likely lead to some sort of inflation. So it's a number to watch. However, it's just a blip. We'll have to see how it does next month, or this current month, in June rather. I am likely not, I doubt we'll see such a huge spike again. I think people are still a little bit more modest and concerned. I personally am too on this channel. You know that I think we should be paying down debt, putting up savings as much as we can in cash or other areas, other asset classes where you think you could make a good return or some potential of not losing your money. So for me, that's currently in precious metals and in cryptocurrencies. Just as an example, personal current transfer payments, which are essentially government-sourced income, in May this number was $5.3 trillion annualized, following the record $6.4 trillion hit last month. You can have a look here, see personal income and government transfer receipts have increased, right? Personal income has decreased, obviously, people being out of work. The government is picking up the slack. Here you can see that government is now responsible for over a quarter of all income. So you take this little portion here, which starts at just over 15%, as you can see. And currently it's spiked to 30%. Currently it's about 25% government transfer payments as a percent of total income. In the 1950s and 60s, transfer payments were around 7%. They jumped again up to the high teens during the financial crisis. The US middle class won't have to suffer this pain for much longer because while the US has one of the highest median incomes in the entire world, it is who gets to collect this money that is the major problem, because as the chart also shows, with just a 50% share of the population in middle-income households, the US is now in the same category as such banana republics as Turkey, China, and Russia. Here's the US, as you can see. Here's Russia, Turkey, and there's China. See, they're all, well, Turkey is just a little over 50%. Same with Russia. They're all just about a little less than 50%. Canada and Australia is up here. Here's many of the other socialist democracies in Western Europe, Norway especially. Of course, there's payment to be made for that. Their taxes are much higher. I'm not certainly a true blue, red-blooded capitalist, whatever you call me. I'm certainly all for free markets, and we don't have that right now, which is the problem. But I think you can have free markets with a social democracy or a socialist democracy or democratic socialism, where those without means are given an opportunity for a leg up. According to the OECD, more than half of the countries in question have a more vibrant middle class than the United States. It has not Russia, nor China, nor any other enemy, foreign or domestic, to blame. He's talking about the US, except for one, the Federal Reserve Bank of the United States. I would also include in that the Treasury and probably the government itself. So this is a concern, not because of governments giving people a UBI or a universal basic income, because that's not what's happening here. I think perhaps that should even be tried over all the stimulus and all the buying of the debt and the bonds that the feds have done. And I know they can't helicopter money to people, but what the government should have been doing is having the Fed buy their bonds so they could give people a UBI rather than all this money going to their cronies in hedge funds and on Wall Street, right? And the top 1.1%. So I'm not necessarily opposed to UBI. I think that's something probably worth trying before we do more stimulus and more buying of corporate bonds and other junk bonds that they seem to be heading towards, and perhaps even buying stocks eventually. But the problem is what happens when this is withdrawn, because this is not a guaranteed universal basic income. This is just a stopgap in the interim, and I'm concerned that A, if the spending continues, we'll have inflation, or B, if it doesn't continue, we'll have other problems. So it's very interesting to see we find ourselves in crazy times. The Fed just bungled its bank stress test, and we spoke about this a little bit as well earlier. This latest round of bank stress tests have fallen woefully short. Stress tests are supposed to help in such situations by showing how bad the losses can get and by ensuring the banks have enough loss-absorbing capital to avoid distress and keep lending. So in the last financial crisis in 2009, they succeeded in part because officials chose to report bank-specific loss estimates. As Timothy Geithner, then Treasury Secretary, put it, even bad news would be better than no news, and he was right. The level of transparency made the US tests much more credible than their European counterparts. That's not the case now. This week's stress test laid bare the limitations of the current regulatory regime. The test's original worst-case scenarios, devised in February, included shocks such as a 10% unemployment rate that seemed laughably optimistic. Today, we're over 20%, despite what the official numbers might suggest. They chose not to release bank-specific results this time, citing the limitations and considerable uncertainty created by the pandemic. The lack of transparency will not bolster public confidence, as Vice Chairman for Supervision Randall Quarles expects. It is already undermining trust, leading observers to speculate that potential losses must be severe if they cannot be made public. And I think that's exactly what's going to happen. We're going to have bank foreclosures and bankruptcies probably in the trillions of dollars by the time this is all said and done, in my opinion. Presumably, also in the name of bolstering confidence, the Fed failed to use the stress test to halt dividend payments. Instead, it will allow billions of dollars in equity capital to leave large financial institutions, even though many firms could well find themselves undercapitalized in the coming months. And this is part of the problem, folks, as you can tell, right? They're giving all this money, it's helping out the 1%, and they continue to demur to the fact that this is actually helping create inequality. Anyway, the Fed needs to change its approach, and this is what this author seems to suggest needs to happen. First, it should let the public know how individual banks performed. I agree with that. Second, it should prevent large banks from dispersing capital for the foreseeable future. I agree with that. Basically, what that means is that no buybacks and no dividend payments. Third, it should require banks that failed the COVID portion of the exam to submit plans to address their capital deficiencies. Agreed. You can see how the market was yesterday and Friday. It was all down over 2%. Crude oil was down almost 2%. Only gold and silver were up slightly. But this is a problem, folks. We have clowns at the helm who aren't really looking out for you and I. And perhaps in fairness to them, they don't understand you and I. They don't understand the man on the street, middle America, if you will, because they have their cronies in big corporations and other sweet jobs that they'll go to when all this is over. But we have to have a look at this. We have to be cognizant of all these things that are happening so that we can prepare ourselves for a future, however it unfolds, so we can be best prepared. Putting our heads in the sand is not what will help us. Another great article from the Northman Trader talking about that we're still in a bear market here. The Fed is the danger. None of what we are seeing here is normal nor healthy as seen in market cap to GDP, and he's talking about the stock market primarily, of course. And this is also known as the Buffett indicator, total market cap divided by GDP. It should be, I think Buffett seems to think that between 60 and 80% is usually where market is fairly valued. Below 60%, you're getting deals, which happened in the 70s, perhaps even into the early 90s. Of course, there was the tech bubble, there's the financial crisis, and look where we are now, at about 150% or more, perhaps. I'm not sure. Maybe he tells us here. It doesn't seem to say, but probably around 150%. Wall Street analysts are reduced to cite nothing but the Fed and further stimulus to justify a buy stocks narrative. Everything is so distorted that the very tenets of capitalism are crumbling. That's true. There's no price discovery left. There's no fundamentals that you could make any argument in any reasonable universe as to why stocks are so highly valued, so richly valued. Just take the month of June. 2 corrective moves in June and both seen markets bounce back on what? The Fed coming to the rescue, right? Fed's plan to buy individual corporate bonds. Bank stocks reverse higher as regulators ease a Volcker rule. Markets peaked on June the 8th. People mostly think of a crash as a fast event, but that's not necessarily so. 2000 was a crash and it took 2 years to play out. You can see here that Dow Jones Industrial Average kind of bounced off and is now actually outside of the channel, the upwards moving channel. You see this with most of them. Here's the New York Stock Exchange. Links below if you want to have a look at these more closely. I'm not sure which one this is. This is the Russell 2000. And here's the VIX, and here's the SPY. You can see they're both bumped out. And this usually reverses the higher the volatility, usually more volatility in downward markets or downward pressure. All except one index, the almighty NASDAQ, managed to hit all-time highs on a negative divergence, hitting a key trend line before being rejected. Let's have a look at that here. Yeah, you can see here, hit the line before being rejected. We'll see what happens. I mean, this is parabolic practically. This is almost a rocket ship. This has to go down. We'll see. We'll see what happens. As you sow, so shall you reap. And I'm sure that the market is going to meet its fundamentals eventually. However long that'll take, we don't know. Equal weighted market in the NASDAQ remains below the December 2018 lows, also peaking in June. So there's the December lows. And yeah, you can see it's still lower than that right now. Equal weighted. The NASDAQ is not equal weighted generally. And as I've said before, I think the top 5, which are generally, I think, Facebook, Amazon, Apple, Google, there's probably another one in there. I missed Microsoft. They make up 20 or over 20% of that NASDAQ market. Here's the S&P 500 peaked on June 8th during the same week when the Fed's balance sheet peaked, as you can see up there. You can't maintain asset price levels this historically disconnected from the economy without artificially intervention and expanding. So far, the Fed has succeeded in its mission to save markets from pain commensurate with the crisis unfolding, but it's just killing capitalism itself in the process. And I'm okay with that. If we were to kill capitalism, that's fine. But we need to come up with an alternative that's better for everybody, and specifically those in the bottom 50, 60%, right? Capitalism has been working so far only because it's the best of all the bad options, in my opinion. Here's the M1 money stock, and the GDP has basically been flattened since then. Here's the liabilities and capital, where the Federal Reserve banks are through the roof. Here's assets and securities held outright in the total assets up there. The Fed is busted and Wall Street exposed to be nothing but a suckling at the Fed's liquidity chest. Rallies still occur when the Fed intervenes, but despite 2 interventions in June, prices now remain below the June 8th peak. Arguably, the Fed is having a harder time juicing the markets again, right? I think there's some fatigue. There's only so much liquidity that the Fed can produce. And I think they're probably hitting that peak. But we'll see. I think the markets potentially could go higher from here, especially up until the election. And then after that, I think it's all bets off. How the bottom-up bailout will impact the future. According to a report from Black Knight, 4.3 million US borrowers were more than 30 days late on a mortgage payment in May. What's more, over 8% of all US mortgages were either past due or in foreclosure. In May, 6.85% of California mortgages were estimated to be non-current. When this year started, only 2.1% of California mortgages were non-current. So now he's talking about what comes next. Over the next several months, the progression will advance from late and missed payments to mortgage defaults and foreclosures. Without question, there will be another monster bailout, but this bailout is bigger than just Fannie and Freddie or even the big banks. This bailout is about a futile attempt to paper over American homelessness and poverty, which is a huge problem, as we've seen, right? That Zero Hedge article talking about how middle America is suffering greatly currently. The people are onto the Fed's money games and demand a bailout too. By this, the bailout will be from the bottom up. The Treasury will provide cash stimulus check payments or directly credit bank accounts to renters and homeowners so they can share in the spoils of a bailout. Our guess is that this sort of bottom-up bailout will be less bullish for stocks, though it will have a much more dramatic effect on consumer price inflation. In other words, the dollar will lose purchasing power against real goods and services, and eventually it'll buckle along with American living standards. Without fail, these pursuits of miracles and purple fairy dust solutions always end in tears. And I think folks are right to demand their portion of the trillions that have been going to the top 1% and the hedge fund cronies and other capitalists out there. Lobbyists, of course. Those are the ones that have the ear of our government, sadly. So perhaps this is an opportunity for a great reset that people have been talking about, where we can actually get some sort of equality. I'm not talking about communism, of course, but I'm just talking about a general equal opportunity for most folks to make a decent life for themselves or to have a decent life, regardless of circumstances that are beyond their control, right? So I'm all for that. However, as mentioned here, there could be inflation if people start spending money and the velocity of money improves. And if they start just giving checks to people again, that'll likely happen, especially if they become consistent. If it's another one-time stimulus payment, perhaps not. Perhaps folks will mostly save those. But as soon as we start spending, we're going to see inflation. So we need to be aware of that. We could have deflation in the next, several months into next year. After that, perhaps towards the end of next year, we could be starting to see inflation, in my opinion. US logged record 40,000 COVID-19 cases in a day as experts brace for rise in deaths. 16 states are seeing both increases in cases and increases in positive test rates. Cases have been increasing in 30 states according to the New York Times COVID-19 tracking effort. On Friday, 11 states set their own records for the average number of new cases reported in the past 7 days, according to the Washington Post. And folks, this is not even the second wave yet. This is just the first wave because America didn't close down properly and for long enough, right? So this is what happens. So be safe out there, be aware of what's going on, and take the precautions to protect yourself and your loved ones. This is the silver futures chart, the rolling average into the next month, and you can see that silver is way off its all-time high, I should say. It's also a little bit way off its low. Let's call the low at about $4. Let's say $4 and the high at almost $50. We're at 18, so we're at about almost at the middle. But if you look at gold, of course, well, let's look at silver again, but just at the silver per US dollars give us a better idea. Pretty much a similar track. Again, we're at about halfway. So arguably, since let's call it 2015, it's been in a sideways channel for about 5 years here. So there's an opportunity for it to break out. Hopefully to the upside, I think, but it could also be to the downside too. But if we look at gold, you'll see gold doesn't show the same opportunities. Pretty much at almost all-time highs, as you can see, just barely off of all-time highs. So this is why I'm a bigger fan of silver at the moment. And then having a look at the cryptocurrency market here, we can see Bitcoin is down, flat over the last 7 days. So I consider these opportunities to buy. I'm certainly looking at buying a little bit more currently. Where's Stella down here at number 14 still. So it's been taking a bit of a beating. There you have it, folks. Let's take a look at the 8 ball. So the question I have for the magic 8 ball is, will there be inflation to the end of 2020? In other words, I'm asking if we'll see inflation this year. If the magic 8 ball says no, of course, then it's likely we'll look at deflation. So we'll get basically the opposite of that, depending on the answer. So let's see what our magic 8 ball economic analyst has to say about that. My sources say no. Will there be inflation to the end of 2020? So they say no. which means we'll likely see deflation, which is what I believe is going to happen as well. And perhaps inflation is upcoming towards the end of next year and onwards. We'll see. Anyway, folks, thanks for joining me. These videos go a bit longer than I want, but there's so much going on in the upside down world at the moment that it's really hard to keep a finger on it all. We need to see past the smoke and mirrors and the fog of hopium that they keep trying to get us to inhale, and sort of focus on what we can do. And I think the best things we can do, of course, pay down debt, grab some savings, stay in cash if you feel comfortable that way. Cash is okay for the next year or so. Take care of yourself, be healthy, be kind, and remember, dum spiro, spero.